Do you want to?
First annual huge marquis client event, or as we were calling it in the office, our marquis client event. We're thrilled you guys are here, so thank you. Thank you for being here. We have with us tonight Burt White, who is the Chief Investment Officer and Managing Director at LPL Financial. Burt doesn't often come out to do these client events, so we are absolutely ecstatic that he's here. And he's here because all of you are here, and I brag to him that I have the best clients and friends in the world. So thank you, Burt, for getting on a plane and coming out for us. We really appreciate it here in Franklin Lakes. Can we just clap a little for Burt? And we're trying, Burt is a great tennis player, so we're trying to convince him to come out and do a member guest and be a ringer. But I'm now sort of giving it all away. When you see Burt, you'll know that he's going to end up winning. So we're thrilled that he's here. Burt is going to speak tonight for about 30 or 40 minutes. It's going to be very entertaining and very lively. And then afterwards, we're going to do a little Q&A together, Burt and I on stage. The hard questions go to Burt, and the easy questions go to me. Okay, so that's the one rule we have. And then afterwards, we have a fabulous hot fudge sundae bar with my favorite flavor of ice cream, which is chocolate chip mix, and other flavors. So we're thrilled you're here. I don't know, who's had the Taylor Teeny tonight, by the way? They don't have the Taylor Teeny? Okay, so we have the Taylor Teeny and then the Burt Weiser. I don't know if anyone had the Burt Weiser. Notice that the beer was named after Burt and the upscale drink was named after me. So, and the other thing is, although we're at a country club, they did not give us a clicker. So I'm going to be doing the clicker tonight while Burt speaks. So I'm going to be sort of like Vanna White. So just be patient with us. We're going to do our best. This is absolutely not rehearsed, as you're going to see in a couple of minutes. So with no further ado, Burt White, our speaker.
Thank you. Gee whiz. It's like the Sonny and Cher show or something. Well, not since the signing of the Declaration of Independence have this many smart people been in one room. So it's an honor to be here. Thanks for having me. I'm going to talk at about 600 words per minute with occasional gust to about 800 words per minute. We've got a lot to talk about. And we're going to talk about is the fact that we had a recession last year. We didn't have an economic recession because actually the economy grew by about 3%. We had a confidence recession. We lost confidence. We lost confidence in America. We lost confidence in Washington. We lost confidence in ourselves. Businesses lost confidence in hiring Americans. We had a confidence recession. We lost our confidence. And we're going to talk a little bit about why we lost our confidence, but more importantly, how we can get that confidence back, why I think it's coming back, and why I think right now is a pretty good time to start thinking about investing for the long term. So we're going to talk about where we've been, where we are today, and where we're headed. So, are you paying attention?
Yes.
So last year was crazy. We had a lot of stuff going on. Crazy stuff going on. Greece and the U.S. was downgraded for the first time ever. We had a real childishness in Washington and so forth and so on. We had an enormous amount of stuff going on. But if you actually look at the returns of last year, we didn't go anywhere. The market was only up 2. In fact, it looked like a boring year, didn't it? I mean, look at all the exciting years we've had.
I thought you were moving on.
We got to have a signal here. Do you want me to clap?
I'm going to get good at this.
Okay, we'll work on it. So you can see some of the exciting years. Look, we had an exciting year in 2002, down 22. It was a bad exciting. Then we had a really exciting year. Look at all these double-digit exciting years. In fact, back-to-back exciting years here. Wasn't so happy exciting. These are pretty exciting. And then last year seems pretty boring. If we actually click next, Debbie, what we can find is that the market actually began at 1257.6. The S&P 500 I'm defining the market as. It's 1257.6. It closed the year at 1257.6. The only 2% you got was the dividend yield. It began and ended at the same exact spot to the 100th decimal place. Put that into perspective. The S&P traded at 14,000 ticks, I mean 14,000 prices throughout the year. Only 56 of those prices were 1257.6, and 2 of them were the very first one and the very last one. It was almost like the year never even happened. It started exactly and ended exactly in the same spot. We kind of wish last year didn't even happen. It was an extremely tough year. But at the end of the day, it was a bizarre one. We traveled a lot of places to go no place, right? So if we go to the next slide, Debbie, what I'm going to show you here in a second is this is obviously the United States, and what we've done by color here is take a look at the GDP. The GDP is the size and the growth rate of the economy state by state. Now this was at the depths of the recession, and you can see there's a whole lot of red. That means that we weren't doing very good. Every state was in a recession, and things didn't look very good. But if we click the button, Debbie, well, this will begin to move forward, and you'll start to see stuff. Just don't touch it. Don't touch it. Just freeze. Okay, see how it's coming? All right, it's magic. Here we go. Now we're starting to see the green shoots of growth come through. Now we're at 2010. You're starting to see these green shoots. In fact, green shoots was a phrase of the year by some places, right? Now, by the time we get to 2010, we got green everywhere. Then the summer comes, we see a little red. That was some of the problems with Europe. 2011 comes, we're green again. Things are looking good until really the summer of last year. And what popped up the summer of last year was a bunch of red, mostly concerns about Greece and Europe. We'll get to that in a second. And we closed the year pretty green. We're about here now. This is kind of what the economic landscape looks now. But if you think about last year, where it started, was basically a country in green. The economy was looking pretty good at the beginning of 2011. And then we stumbled. We had a stalemate in Washington. We had problems in Europe. And that created a soft spot in this economy and a tough spot for the market for about 6 months, until we ended up in a pretty good spot. Now, if we click, Debbie, we can move to this whole concept of the disconnect. They always seem to put the word great in front of things that are bad, right? Like the Great Depression. And then we call it the Great Recession. I call this the Great Disconnect, because last year there was a huge disconnect. What a lot of people remember is the bad stuff. We had problems in Europe, we had a weak job market. But what people don't realize is this side. Last year, companies made more money than any other year in the history of the market. In the third and fourth quarter of last year, when things were really tough, companies had higher earnings, higher sales, higher revenues, higher profits, and higher cash than any other moment in the history of the economy. It didn't feel like it, did it? It felt pretty tough. But we actually had record corporate profits. Record. Companies were more profitable than they've ever been. And it was this tug of war, this back and forth between the concerns of Europe that was tugging on one side, and on the other side, businesses were doing pretty well. Not great. I'm not talking about a Disney economy. It wasn't like rainbows and unicorns. We're not talking that good. But it wasn't the apocalypse that many people thought either. And it was a real tug of war between good and bad last year, and it drove the market back and forth. And what we're going to do now is talk a little bit about that. Now, one of the measures that we look at very closely is this concept called consumer confidence. And it's very simple. It's a phone call that comes to you right at the wrong time. You're usually sitting down at dinner. And someone calls and you'll know it. It's the one that says, I'm not trying to sell you anything. It's that one. And you say, well, you know, that you're just a bad telemarketer, and you hang up on them. Well, that ends up to be oftentimes consumer confidence. They're going to call and ask you a few questions. They call a whole bunch of Americans, and they do that every day. And they pull them together, and we create this yellow line, the green line, which ends up to be something called consumer confidence or consumer sentiment. And this ends up to be consumer sentiment, the green line. You can see in 2002, 3, 4, 5, 6, 7, consumer sentiment was relatively high, and then it fell off the face of the planet. Now, what's the yellow line? The yellow line is GDP, or a measure of our economy. That's the nation's checkbook. This is how big our economy is and its growth rate. What you note is these two lines are usually very similar. Note back here how closely those lines move together, and in the recession how closely they move together. And it makes sense, doesn't it? Because 70% of the economy is you. It's not the government. It's not businesses. It's you. Consumers are 70% of the economy. Our spending. Walmart, going to get a blooming onion at Outback. That is us, right? We are the economy. So it makes sense that as we feel less confident, the yellow line, the economy moves lower too. Because if we're 70% of the economy and we're not confident, we're probably not spending. And if we're not spending and we're 70% of the economy, it's not growing. And that's what happened. But notice that for the first time in the 70 years that they've been tracking this, you had this dispersion. This was the summer of last year. The summer of last year, we felt as bad as we did in the depths of the recession. And you go all the way back to the Great Depression is the last time we felt that bad. That's how bad and unconfident we felt last summer. Put it in perspective. At this point in the Great Recession, we were losing 600,000 jobs a week. That wasn't good. At this point in the recovery last summer, we were gaining 120,000 jobs. And yet we felt just as bad. We lost our confidence in something. It wasn't the economy, because that's the yellow line. The economy wasn't great, but it was pretty good. In fact, it's kind of about the same growth rate as it was back in 2002, 3, 4, 5, and 6, when things were okay. But it was something that made us lose our confidence. And this disconnect is the biggest one we've ever seen. Go to the next one, Debbie. The same thing here. The green line this time is the consumer confidence. Same thing I showed you before. The yellow line is how much money we spend at the malls. Notice how they're pretty similar over time. The yellow and the green line follow each other. It makes sense. If you feel confident and you tell people you're going to spend money, typically you go to the mall and you spend money. But last year it didn't work that way. Last year when they called us up, we told them we would never spend another dime again. And then as soon as we hung up, we said, get the kids, let's go to the mall. Because we were spending like there was no tomorrow. This disconnect was enormous. One of these numbers was right, one of them was wrong. It ends up, it's probably closer to the middle, but at the end of the day, we had a confidence recession. So let's talk about, Debbie, why we might have lost our confidence. Well, the first thing that I would argue is that we were afraid we were going back into a recession. You heard a lot about double dip recession. One of the things we do is we track the number of times someone Googles the word recession. And we do this for about 150 words that we track every week. We have one of our assistants go in and type in those words, and it pops up how many folks Googled it. And you can look at that over time. And what you found was a spike in the number of times people were Googling the word recession last summer. We were concerned about a double dip. I'd like to introduce you today, if we can click this, Debbie. I'd like to introduce you today, in a few seconds, to the two best economists on the planet to predict recessions. They're not people, they're indices, and we'll show you them in a second. But what a lot of people don't realize is what we've been through the last 3 years is the greatest 3-year bull market coming out of a recession going back to World War I. It's astounding. The market's up 111%. This is through today. Up 111% from the bottom when it peaked at, when it troughed in 2009 to today. It's been about 3 years, a little more than 3 years. We're going to celebrate the 3-year anniversary of the bull market here in a second. Up 111%, and look how much higher it is than all those other first 3 years out of a recession. This is the greatest bull market out of a recession we've ever seen. But has it felt that way? Has it felt like the best time to invest? Has it felt like the best bull market? It hasn't, has it? It's felt fragile. This recovery just felt like it could slip through our hands at any point in time. And I actually think, if we click here, I think I know why. It's because if you look at the anniversary gifts, you've seen these where they give you the tables of what you're supposed to give. These are historically what you're supposed to give. So in the first year, you're supposed to give a piece of paper, I assume. And after 3 years, Debbie, you should have gotten from your husband a leather belt or something, right? But look at these gifts. Crystal is the 3-year in modern time. And I think that's appropriate because this bull market has felt fragile. It's felt fragile like a bull market, or like a crystal. Like you could just break at any point in time. Now, if we click here, I'm going to introduce you to the two greatest economists. The first economist is an index called leading indicators. And you can see the leading indicators, it kind of goes up and down. Here's the recession. And right now it's at about 3.4. What does that mean? Well, if we look at it, we can see that it's done a pretty good job of predicting recessions. In fact, if the leading indicators is less than 0, if we go back, Debbie, there you go. If it's less than 0, we have a really good chance we're going to have a recession coming around the corner. But where is it today? Well, it's somewhere between 2.5 and 5, which tells you that there's virtually very little chance A 1 in 100 chance of a recession this year. Doesn't mean it can happen. It means it's highly, highly unlikely to happen. And this should be something we should be confident in, that we're not going to have a repeat of a double-dip recession. The next one, if we can actually confirm this, is actually a thing called the yield curve. Now, the government issues debt, right? It issues treasuries. It borrows money from us, and as we know, it borrowed a lot of money because it's got a lot of debt, right? And they issue those things, and they have different maturities of those bonds that they have, right? They have short bonds where they borrow money for a month or 2 months or 6 months or 3 years, and some that they borrow money from us for a long period of time, 10 years, 20 years, 30 years. The difference between longer term debts that they borrow and shorter term, you can measure those, and that measures whether or not the yield curve is steep or not. And what you see is this is a difference. We're going to show you the difference between the 10-year yield and the 3-year yield. Now, typically you're above the line, because that means that the 10-year yield is yielding more, giving you more income, than the 3-year yield, which makes sense. Because if you're going to give the government money for 10 years, you're going to want more money back than if you're going to let them borrow it for 3 years, right? You're going to want more of an interest rate. You're going to want more money back. So typically it's like that. But notice, if we click here, Debbie, just click again. Notice all the times right before recessions, it dips below zero, dips below zero, dips below zero, dips below zero. It always predicts it pretty well. Where are we today? Debbie, we're way up here. We're so far away from recessionary times. And I think this is a level of confidence we shouldn't worry about. All right, let's click next. But what most people say is, but Burt, it's different this time. Because we got scary things like Iran and all the stuff they're doing. We got high oil prices. We got a financial crisis. And what I'm telling you, this has always predicted it. It worked during the Cuban Missile Crisis. If we click, it worked during the oil embargo. If we click, it worked during all the problems we've had. This has been the best predictor. And what it's saying is we will not have a recession anytime soon, at least this year, which is pretty good news and should raise our confidence that this market and this recovery is here to stay. Why is it here to stay? Well, the first thing is business spending. What government calls business spending is manufacturers' new orders of non-defense capital goods. We just call it business spending. This is businesses buying new phones and new computers and things like that, new desks. And you can see that they just cut their spending dramatically. In fact, in the depths of the recession, it was the lowest number of new patent applications in 100 years. They weren't researching. They weren't finding new medicines and new drugs. They cut it all. They cut to the bone. What's the purpose in curing cancer? What's the purpose in curing Alzheimer's if I can't benefit from it as a drug company? Should at least cut that cost. I'll get to it later when the recession's over. That's what happened. And here's personal consumption. This is how much we cut our spending back. And you can see we cut our spending back a fair amount. And that's beginning to come back. So you mix these two things together, businesses and us as consumer spending, and it's really driving this recovery. Again, we're not talking unicorns, we're not talking Disney, we're not talking rainbows and pixie dust. It's not that good. But it's not the apocalypse into the world that a lot of people think it may be. So if we click here, Debbie, the good news is that if you do make it 3 years, every time we've also made it a 4th year. So we're in the 4th year now. And the good news is if you make it 4 years, you always make it 5 years. Now, I'm not saying that that's going to happen this time. I'm just saying it always has, which is pretty good. So the real key is to make it 3 years into recovery. Because if you make it 3, you typically make it 4 and 5. Now let's talk a little bit about the rest of those gifts as we go further out, right? Here's the old days. They weren't so great. I think I've figured out why there's a 7-year itch. You've heard about the 7-year itch, right? Here's why I think it is. Guys, this is the reason. When we go and look for gifts, this is what we provided. A toaster, silverware, wooden objects, and like a desk set. If I gave those 4 things to my wife, she would also have the 7-year itch, right? So at the end of the day, that's why they have them. But the big thing here is at 10 years, you get the diamond. And as far as I'm concerned, I think this, if we click it, Debbie, I actually think this recovery is better than a crystal, but not as good as a diamond. This is better than a crystal market because we've got a lot of pretty good things. We've got an improving labor market. We've got both of those two economists saying pretty good stuff. We've got easing central banks, meaning the Fed is on our side. We've got good business and consumer spending. That's all pretty good. But this is the stuff we're still worried about. This is what makes it not the Disney and unicorns and rainbow type market. But we still have some things we're worried about. We'll talk about those in a second. All right, let's. Before we get to Washington, let me tell you a quick story, if that's okay. So, I have 4 kids. Does anyone here have more kids than me? Nobody. It's very rare. I don't only have 4 kids. I have 4 daughters. So when someone asks me how many kids I have, I usually tell them 8, because daughters count 2. How many kids do you have? Do you have 5?
3.
Well, but 2 are daughters,
Yes.
right?
Yes.
So you have 5.
Yes.
Okay, so because daughters count twice, because they're twice as hard.
Caroline counts 5 times.
There you go. So I have, what makes it worse is I have twin 14-year-olds, daughters. So I have twin 14-year-olds, their name is Morgan and Taylor. I've got a 9-year-old, her name is Dylan, and we shortened her name to Dill, and then that turned into Dill Pickles, and now it's just Pickles. And then we like the whole name something after food, so we named our 3-year-old Olivia, and we call her Olive. So we have Olive and Pickles, and we're going to rename Morgan and Taylor, the twins, Celery and Carrot, and make a whole relish tray, right? Anyway, Pickles wouldn't stay in bed. She would get this bad habit of getting out of bed and getting into bed with Mommy and Daddy, and she does every night. And my wife doesn't mind, because she sleeps through anything. But for me, once Pickles gets in, I can't sleep. So this was a problem. So I went to the twins. And Pickles' room is on the far side, and the twins are in between. And I said, we have to make sure that Pickles does not get to Mommy and Daddy's room. So we did everything. We put like a tripwire out, so when she would kind of walk, she would trip and fall and wake everybody up. We put her back into her room. We actually got like a soda can and put coins in it, so that we put it on her door, so when she opened it, it would rattle. And that all worked really, really well. But then the problem happened. I was going on a business trip for 3 days. And I knew without my leadership that Pickles would fall back into line and start getting back into bed with Mom and Dad, and would just start the whole thing over again. So I told the twins, whatever you do not let Pickles get in that bed with Mom. So I go on my trip. I'm there for 3 days. I take the red eye back. I get back in the morning, and one of my daughters is getting an award at school, and so I'll go right from the airport to the award ceremony. And she was really cute. She gets up on stage. I get there just in time. She sees me. She waves, and she comes up. She's really cute. She's like, and I'd like to thank my teachers, my parents for the homework, and all that stuff. And then she starts to walk away and sees me and says, "Oh, and Daddy, while you were gone, nobody slept with Mommy." Yeah. So that is true. That's actually true story. So that's expectation. That's the playfulness and how bad that was not good. The same is true. The same is true with Washington. Let's talk a little bit about politics. All right. You ready?
Yeah.
You can click the button. There you go. So it's interesting. I've been watching this for years and years and years, and actually, the 4-year presidential cycle for markets acts the same every time. The green line is the average of all the cycles going back about 30 years. And so what happens is, notice what happens in year 1. In year 1, the green line moves higher. We get a new president. They told us a bunch of stuff. We believe it. We think they're going to change the world, and that's good news. Look what happens in year 2. It goes sideways. We find out they lied to us. They're not actually going to do anything. This president's not going to help us at all. In the 3rd year, it moves higher because we finally realize it's half over. We can get a new president. Then in the 4th year, we get concerned because we don't know exactly who's going to be president, and it goes sideways. Can we go back? It happens like that every single time. Here is what happened this time. Here's the yellow line. We came out to a bad start, but we ended up perfectly. Year 2, pretty perfect. Year 3, we disconnected last year because of the problems with Europe, but we're now right back to about where we were. And this makes me think that what we're going to have this year is pretty sideways market. We're up about 10% so far this year. My guess is we're probably going to be plus or minus 5 from here. That's typically what you get in an election year. You get a market that moves up a little bit, moves down a little bit. It's pretty volatile until you know who's going to win. And then the market actually moves higher because it finally has an answer. But I'm here to say, regardless of who you want to win as president, the market doesn't care. The market doesn't care about the winner of the presidency. It's just not that important to the market. The market's more worried about Congress. But if you want to know who's going to win, I'll tell you the one stat that has always worked except for one, and that's this one. If you want to know, this works really well. The only time it didn't work was Gore. But other than that, it works most of the time. And here's how it works. On this axis, you've got the percentage of the vote by the incumbent party. And on this side, it's how much your raise went up, how much your income went up after taxes and after inflation. It makes sense. The better you're doing now, the more votes you give for the president. And the worse you're doing, on the far side, the less votes you get for the president. When I did this a year ago, we were, let me go back one, you're really fast on the trigger here. We were about right here, saying that President Obama would get about 45% of the vote and lose in a landslide. Now, it's even worse. It would say that he would do worse than Walter Mondale. Now, I don't think any of us believe that's going to happen. But at the end of the day, what this is telling you is the power of economics. The power of how you feel is powerful. Now, I don't know if it's going to work this time or not, because what it says right now, we got a long way to go before the election, but what it says right now is that Obama's got a tough row to hoe from an economy perspective. The thing is, it's getting better. But the market doesn't care. What the market cares is the next one. And that is all about Congress. At the end of the day, we've always learned that gridlock is good. But we've learned over the last couple of years that gridlock isn't good. Washington got nothing done. And because Washington got nothing done, it put us in a pretty tough spot. The U.S. got downgraded and a bunch of other things happened that wasn't so great. So I think we need action. Now, the interesting part about this, and what I'm showing up here is the Senate. Because the House looks like it's going to stay Republican. They have a pretty strong majority. And if you look at the polling right now, it looks like they're going to hold it. The real thing people are watching is the Senate. Now, one third of seats happen every 2 years. A third of them happen this year. And what I'm showing you here is the ones in red and go back one. Red and blue are the ones that are up this time. So you can see that Texas has a Republican senator up, and then here in Florida you got a Democrat. But what's interesting about this is if we click it, you've got these are the battlegrounds, and it just so happens two things you notice. One, there's more blue than red, which means there's twice as many Democrats that are up for re-election this time than Republicans. So they have more to lose. They have more to lose. And so if you just flip a coin, it looks like the Republicans can win. These are the battleground states. There are more battleground states that Democrats are fighting for than Republicans. And if you look at the early polls, we're very early, it looks like the Republicans will take maybe a 1 to 2 seat majority in the Senate. What the market wants, I'm not a political person, I don't care. But what the market wants, don't yell at me, don't get mad. What the market wants is a Republican to control Congress, to control the legislature, and those things that are going to be passed through, and wants a Democratic president. That's what the market would love. The market would like that because you have gridlock, but not gridlock within Congress. And then things would get done. The last time we had that was who? Clinton. The market would love that again. I'm not saying I would, not saying you would, I'm just saying what the market would like. And that looks like we're headed that way. All right, let's go. Here's the things that concerns me the most. What concerns me the most is obviously the spending in Washington and the debt that we have. We know that's not good. We know it's bad. But here's the interesting part of this. The interesting part of this is these are all the cuts that are coming if we do nothing. Right now, these are the cuts that are coming. The expiration of the Bush tax cuts, the payroll tax cut for workers, debt ceiling, a bunch of other things. It totals $536 billion, which ends up to be 3.5% of our economy. So we're reducing spending. If we don't do anything, this is what we're reducing by 3.5% come next year. To put that into perspective, 3.5%, that's what this is the biggest cut in spending in any year going all the way back to the late 40s. And we've never cut more than 2% in a year without having a recession the next year. What has me concerned is the fact that we're using not a scalpel to cut, but a baseball bat. And what we have to be is smart. In my opinion, we have to be smart in how we cut. We do spend too much. We have too much debt. We've got to fix that. But what we can't do is use a baseball bat to do it. We've got to be smart about how we do it. And this is the biggest concern I have. The biggest concern I have and the biggest concern the market has is this. Cutting spending by 3.5% like that will give this market a whiplash. And we've got to be concerned about it and watch it. The other thing that a lot of people were concerned about last year was jobs. And I heard a lot, if we click here, Debbie, that this wasn't a very robust jobs market. But in fact, it's gotten pretty okay, and it's actually on pace with other recoveries. Here's the recoveries coming out of the bottom in the job market in 2003, following the 2001, 2002 recession. Following the 1990 recession, this is when jobs bottomed. And you can see this is the recovery in both of those. And here's where we are now. Jobs bottomed in 2010, and they've been recovering since, and we're right in line. This isn't a robust jobs recovery, but it's normal. It's just like every other job recovery. But one of the things that I watch very closely is this chart. Now, how many people watch this? It's not a very well-publicized number. It's called JOLTS. And it stands for Job Openings Total Private Seasonal. And one of the things we watch very, very closely is this. Now, what it measures is not only how many people lost their jobs, but why. So why might you have lost your job? It's a reason. Laid off. It's another reason you might not have a job. Merged. You died. You retired. You might not have a job because you quit. Quitting is one of the big ones. And one of the things that we watch is what percentage of job losses were because somebody quit. Why is that important? Why is that important? The main reason why it's important is why would you quit your job? Because you hate it. No, you don't quit your job because you hate it. You quit your job because why? You got a better one. So what we watch is what percentage of people that changed their jobs were because they did it voluntarily. In the depths of the recession, it was only about a third. It was a very small ratio, and now it's moving higher, and it's about half of separations are now voluntary, meaning they're quitters. They quit, they found a new job. And that is usually the sign that the labor market is recovering. So we think that while this isn't a great job market, it's not spectacular, it's not bad either. So let's move to the last part, which is Greece, Portugal, and China. There's a lot of concerns about Greece, obviously, and Portugal and China, and a bunch of other things outside the United States. So if we click it, we can look at this. The big thing for me is that we're so concerned about Greece. And Greece is about the size of Arkansas from an economic perspective. So it's not over. I mean, if we lost Arkansas, would any of us be upset? And the same is true with Greece, right? I mean, what does Greece do, right? That's like olive oil and feta cheese. So at the end of the day, if we lost Greece, I'm not so sure if we're overly concerned. I understand the debt that they hold is owned by banks, German banks and French banks and others. We've got to watch that. But they've been reducing that exposure. They've reduced it by 80%. But the bigger point here is in the United States, while we trade a lot with Europe and we're concerned about the recession in Europe, we actually trade, if we go back, Debbie, 4 times as much with emerging markets. We're in the precipice of a new time. The world, for the first time, if we click here, for the first time in history, emerging markets is now greater than 50% of the world's economy. Think about that now. Those small countries in South America and Africa and Asia that we call emerging markets are now the majority of the world's economy. The big developed economies like the United States and the UK and Japan are now for the first time this year less than half of the world's economy. The world's changed. The world's an emerging market now. And it's that growth that's going to fuel our success. It's It's the growth of China. It's the growth of India. It's the growth of South America. It's the growth of Africa. That's what's going to drive it. If you look at Apple's sales today, they were great. Apple's posted great sales. They blew it out. In North America, they were okay. But they killed it in China. And they killed it in India. They killed it. That's where the growth is. The U.S. is growing at 2.5%. Japan's growing less than 1%. China's growing 8%. India's growing 9%. Brazil's growing 12%. That's the growth. Emerging markets is the growth. And we're so concerned about Europe. What we should be more concerned about is emerging markets. And if we click, Debbie. And China is beginning to lower their interest rates. China had a growth problem. They were growing too fast. The interesting part is, who here has refinanced a house lately? Someone refinanced? What's the interest rate they're refinancing now? 3-4%, something like that. If you're in China, it's 21. They've had their foot on the brake, trying to slow their economy. They were growing too fast. They're worried about inflation. What's happening? They're beginning to cut those, and that's going to really spur that on. That's why I don't think we'll have a recession. So if we click, what's going to happen in 2012? Well, here's our view. Our view was that big disconnect that was going to happen, the big disconnect between corporate profits on one side and Europe on the other, all the concerns we had on one side, but record profits of companies on the other. That disconnect will slowly come back to the middle. I think that this is going to be a year of the middle. I think we're going to have middle, kind of muddling, boring returns. I think we're going to probably get about 10 to 12% this year. We're up, 8, 9, 10 now. I think we're probably poised for another plus or minus 5 from here on out. I think the winner of the election will be those who appeal to the middle. I think it's all going to be about the middle this year. That being said, I think that emerging markets is a great place to invest. That is where the growth of the world is. That's where the engine of growth is. I think that's a great place to invest. And we're certainly recommending a large amount to emerging markets. And then those businesses that really sell into it. Things like industrials and materials and energy companies that sell and fuel that growth, we think will do very well. If we click, Debbie, this is a chart showing what normally has happened here is we've always kind of entered a tough period right around May. Here's the last 3 years. And you can see coming out of the chutes, they've all kind of come up until about May. But then the market slid each of the last 2 summers. And the question is, will it happen this time? And I believe that while we're going to have some volatility here over the next month or 2 or 3, I don't think we're going to get what we've got in the last 2 summers. Europe's in a better spot than they were. And we've got Europe now lowering rates, not tightening rates. So they're actually helping, not hurting. And you've got China beginning to fuel its growth. In addition to that, we're 3 years into a recovery. And the labor market is getting better. And the U.S. consumer is now spending money. And you mix all that together, it ends up to be a recipe that I believe is going to be pretty good signs for the market. And let me end with this. We talked about confidence. Let's end with confidence. We actually have consumer confidence. I mean, you can measure it if it's really low or really high. If it's really high, it's greater than 110. That's when things can't get any better. And when things can't get any better, rarely do they. Because a year later, where's the market? It's down. But go to the top. You've heard the saying before, if you just can't get any worse. Well, when consumer confidence is as low as it can be, when it's below 60, when it's awful, when we're hanging up on them and telling them we're never going to spend money again, that is typically the time you want to put money in the market. Buffett said it best, be greedy when others are fearful, and be fearful when others are greedy. Right now, people are scared. They're fearful. This is the time to be greedy. This is the time to exploit that. This is the time to put that money in the market. You've got one of the greatest financial advisors on the planet that sits here with you, and Debbie Taylor and her team. And I'll tell you, my 50-person team stands beside her to help provide her with any advice we can. And what we believe jointly is that this is going to be a volatile market. But at the end of the day, this is a good time, good long term, a good time to think about the long term. If you've got money sitting on the sidelines, I think it's a good time on these dips to start putting that back to work. Because over the next few years, I believe this recovery will be there. Every time we've had a 3-year recovery off a recession, we've had a 4th and a 5th. We're only partly through the 4th. We got another year and a half here. I believe we will get it. The big risks, Washington. But we'll take care of that in November. America will vote the way it's going to vote. I think we're going to get to a better spot. If we get there, I believe we're going to see greater times, greater prosperity for the next couple of years. Can we end with a magic trick? You want to end with a magic trick? You want to do it? All right, I'm going to make it rain in here. Have you guys ever had it rain inside? First of all, are you guys awake? You guys realize you slipped into the third stage of audience consciousness. Do you realize that? You know the first stage is called the oil painting stage, and that's where you can see it. You see how they begin to kind of just blur together, kind of like a Monet, right? Okay, that's the oil painting stage. You guys were into that before you got here. The second stage of audience consciousness is actually called the jury phase, and that's where you actually look like you're about to render a guilty verdict, and clearly you're doing that now. And the third stage, which you rarely see, but thank God you gave it to me today, is pre-anesthetic. And that's where we can just come right through and just harbor donor organs. I mean, really. You guys are that asleep. Okay, so let's just end with a magic trick real quick. Here's my belief. My belief is that we've got to come together as a country. We've got to come together as Republicans and Democrats. We've got to come together to solve this. As a world, we've got to come together. We have big problems. Global warming is a big problem. Pollution is a big problem. Overpopulation is a big problem. We got problems everywhere. And we're going to have to do that. In my mind, how things combine, how we bring things together matters. Our relationship with each other, your relationship with one of the best financial advisors on the planet, our relationship together as a team, these are all extremely important. We're going to do something and a test of that today. We're going to make it rain in here. So, if your last name starts with the letter A, B, C, D, E, F, G, or H, raise your hand. Okay. You're group 1. I need for you to put your hands together like this. This only works if we all do it. Right, here we go. And rub your hands like this. Can you do that? Yep. Save yourself. Okay. A, B, C, D, F, G, H. Okay. If your last name is I, J, K, L, M, N, O, P, raise your hand. Okay. You're group 2. I need for you to snap your fingers like this. Can you do that? Yep. Okay. And now if you're, what is P? If you're Q, R, S, T, U, V, W, X, Y, Z, or you don't know your last name, you're in the group 3. You're the most powerful group. Where's my group 3? Okay, there you are. The tail. Now this is what I need for you guys to do. I need for you to go like this on your legs. Can you do this? Okay. Now listen. All right, just save yourself. You're ready. These things mean nothing by themselves. These sounds mean nothing. But when you put them together, they're magic. They make a magic noise. They make something magic appear. And I believe if we can do that, you partner every day with people and make magic. Whether it be your spouse or your partner, whether it be the people you partner with in business, like Debbie Taylor and her group. Wherever it is, it's magic. Let's do it today. Here we go. Let's do group 1. Group 1, like this. Okay, group 1, a little louder. You need lotion. Okay, group 2. Oh yeah, it's coming down. Here.
I love this.
And here comes group 3. Oh. Okay, 3, 2, 1. That's magic. That's it. Thank you. Thanks for having me.
Okay, well, we are right on schedule, Burt, and you were fabulous as always. So we're going to take questions for the next 10 minutes. But before questions, just two quick things. First, we're going to have questions for about 10 minutes. Public service announcement. First of all, I want to acknowledge the Taylor Financial Group team. So if you guys would just stand up real quick and wave to the crowd. This night would not have happened without them. Jen, Cheryl, Amy, Josh, Steve, and Matt. Stand up. Thank you. So that's the first thing. The second thing is somebody asked where we got the beautiful centerpieces, so I want to acknowledge Lauren Faustini, my good friend. Thank you, Lauren, and our ace tennis player for the night. And then the final thing someone mentioned is the photo booth outside. So please, after we're done, I would love you guys to go out to the photo booth because it's a lot of fun. There's hats and props, and it's a lot of fun. Okay, we're going to do 5 or 10 minutes of questions. We have a few written down here, or does anyone want to raise their hand, or we can go to some of the written ones. Is anyone like really eager but didn't write it down? And Kevin, no, you can't ask a question. Yes, Mark.
Well, my question is, and I think Charles Munger was under Buffett.
Yep.
He was the idea guy.
Yep.
So.
Repeat the question.
It's halfway through.
So, as your personal self, if you had $10 tomorrow, and you had an idea to invest it in, what would it be?
It's a good question. That's a hard one. So that goes to you. Would you do the hard ones? I do the hard ones. If I personally had $10, I have $10. I could invest in any idea.
What is your idea? I mean, because you said a lot of stuff, what's going on around the world, a lot of statistics. What would you do with your money personally?
Right. Well,
what do you believe in?
Okay, a few things.
I do have a few ideas after you go,
Perfect.
depending on how well you do.
A few things. Number one is I'm a huge believer that there is going to be an enormous growth of the middle class in emerging markets. They want your life. They want your Levi jeans. They want your Outback Steakhouse. They want your iPads. And they haven't had it. They have not had it. If you look at the emerging market cycle, 200 years ago, the United States was an emerging market. We're a brand new country. The biggest economies in the world were China, the UK, and others, right? We now, 200 years later, now are the biggest consumers. Because we looked, for 200 years, we looked at bigger economies and said we want to be like them. And we will spend like them. And now we are them. These emerging market countries now are going to be ferocious spenders. India and China and Brazil and others. So I would tie anything to that. So if I had to invest in any one thing right now, I'd invest in Brazil. I'd buy a Brazil country fund. Why? A, the demographics look great. B, it's an emerging market country that's growing quickly. The Fed is on their side and lowering rates. And most importantly, they have 2 huge spending events that are coming. They have the World Cup, followed by the Olympics. And those are coming in the next 6 years. That spending is going to drive that economy. There's never been a place that's had both 2 major world events like the World Cup and the Olympics and not seen double-digit GDP growth over the next 5 years leading up to it. That's going to be huge. So I would invest in Brazil. The other thing I would do would be another idea, and that's agriculture. This world is multiplying at enormous rates. And there's going to be a point where we're already there, where we can't feed it. We can't feed this world efficiently. We can barely feed it at all. And at the end of the day, while it's not fun to say, the price of food will go up. And the reason why the price of food will go up is because there's going to be more and more demand for it. So I would buy agriculture, whether it be those that factor into agriculture, things like companies that help to create it, whether it be the fertilizer companies or whether it be like John Deere or Caterpillar that build those to make them and others, water companies. I think anything tied to that cycle, because I believe I'm a cyclical investor. Over short periods of time, you invest, but over long periods of time, demographic themes and cyclical themes win. And I believe that these themes, this theme of the world getting bigger, the emerging consumer in the emerging market world, and then how ferocious, whatever that is, how ferocious their spending will end up being. I would invest in those 2 things: agriculture and emerging markets, namely Brazil. What would you say?
Fair enough. I mean, we've been having this conversation with clients quite a bit about the growth of emerging markets. So I think that's a great answer, Bert.
I talked too much and then weeded you out. You couldn't talk.
No, it's the answer. It's the right answer.
Perfect.
Well
Glad I
done.
got it right.
Okay, good. Any other questions? Any other questions from the audience? That was actually one of the questions. Good.
Yes, ma'am.
My question is, I noticed that in your alpha-focused investment portfolio, you increased your position in Columbia Recovery Infrastructure.
Yep.
So that's kind of been like a drag on the portfolio.
Yes.
So I was wondering why and where you see that going.
Yep. So for those who
Can you repeat the question over the mic?
absolutely.
On the mic. Can I do on the mic? Oh, you have the mic.
I don't want to.
Okay.
So the question was for those that have there's each one of you have a slightly different portfolio, but for many of you, you have something called Alpha Focus. It's a type of investment, and within that there's a fund called Columbia Infrastructure and Recovery. And it hasn't been a great investment. It hasn't been a great investment. And we've recently added to it. And the question was, why on God's green earth would you buy that thing, right? She said it nicer. So I'll answer it. Let me tell you why we bought it, first of all. The reason we bought it was that they are infrastructure companies, and primarily the infrastructure companies were those centered around Asia. So when the Japanese tsunami hit, our thought was that they would do what they've done over the previous tsunamis and earthquakes, and that was build back quickly. And by building back quickly, what they need to do, they couldn't do it internally. They had so much damage. They have to go out to other places. Where do they go? They go to their closest neighbors. And so they go to Hong Kong, they go to Australia and others, get these companies that go in and help rebuild their infrastructure. Their port was gone, their roads were gone, their energy was gone, and these companies come back in and fuel it up and get it fixed. That was wrong. What happened was they didn't do that. It was a largely agricultural town, and it's in shambles today. So that was what was missed. What was interesting about it, though, is there's a second thing we love about it, right? And that is the fact that we didn't have to just have the building cycle of Japan to benefit. What we're seeing is a global benefit. Go back to Brazil. It also has Brazilian infrastructure. Somebody's got to build the new soccer stadium and the new football stadium and the new water polo stadium, and that all comes from these infrastructure companies. The same is true in Middle East. You had the Arab Spring that happened. It's interesting that one country, the one big country, the really big one, that never had any problems was which one? Saudi Arabia. That's the one we got to watch now. What happens to any of those other ones are one thing, but if something happened to Saudi Arabia, that's a big deal. It's about 40% of the world's oil. That's a big deal. So at the end of the day, Saudi Arabia did. You know why? The king came out and said, I'm going to spend a bazillion trillion million dollars on building new stuff for you. Just don't overthrow me. And they announced that infrastructure bill. Well, someone's got to build that stuff, and that's these companies. So we've added to it. What happens is, and there are highly emerging, there are a lot of emerging markets infrastructure plays. And so while that hasn't worked yet, we're huge believers in it. And over short periods of time, we've gotten that wrong. Over long periods of time, as the 50% of emerging markets, as that gets bigger and bigger and bigger, they want your life. They want this country club. They want Myrtle Beach. They want Atlantic City. They want Las Vegas. They want that in their country. They're going to build it. And to do that, they need the infrastructure companies to do it. That's what this fund invests in. So while it's not a short-term holding, it's a long-term holding, and it's a big one that we believe in.
Yeah, we agree. We love the secular story about emerging markets. So yeah, but over the short term, it's been a little rocky. We're going to have time for one more question because we have dessert. But before we do that, we have to have our drawing. So you folks have seen my family, Caroline, who is our photographer, Cece, my husband, Rob, and now we're going to have Bobby come on stage, who is my absolute, come on, Bobby, you got to do the drawing. So Bobby got paid 50 cents a ticket to hand out tickets tonight. So any of you who got 10 tickets is because Bobby was gaming the system. And then grab the poll, and Bobby's going to pick out a few tickets, and we've got a few prizes to give away. All right, Bobby, ready? He's closing his eyes. He's so honest. All right. Okay. You got to pick it? Okay, read the number. Everyone's got your tickets. Want me to read it? 137004. 137004. You get the Taylor Financial Group blanket. And it's Lanzette. Very good. All right, Bobby, let's do it. Thank you, dear. All right, let's do another one, Bobby. Don't put that ticket back in because then he went twice, right? Oh, you gotta put your hand in. Good. Okay. You're gonna read it?
137045.
Okay, who do we have for that? And this is a very fancy Nomura. I'm not even sure what this is, but the guys in the office coveted it, and I said, no, you can't have it. It's a big duffel bag thing. Do we have the taker for this one?
137045.
Do we have a winner for the duffel bag that the guys in the office wanted? No? All right, we're going to go to another one, Bobby.
1, 3, 7, 0, 5, 9.
Oh, Rick! Excellent. All right, let's give a hand to Rick. And then the final prize is like, is this the deluxe golf prize? Thank you, Rick. The final prize is some deluxe golf prize, right? Is this it, guys?
Yeah, there's the golf shoe bag.
Is that over here, the golf shoe bag? Okay, so we have a golf shoe bag. Didn't we have other stuff with this, like balls and...
And this Taylor Fraser balls.
Okay, good. All right, Bobby, close your eyes.
1, 3, 7, 0, 1, 2.
Why don't we say it again?
1, 3, 7, 0, 1, 2.
Do we have a taker? Oh, she wins the golf deluxe prize. All right. So I have no idea what this stuff is. I tried to play golf for 2 years and spent a fortune and just gave up. But that is some golf. Wait, we got more. And the Taylor Financial Group towel, and there's Taylor Financial Group golf balls in there. So do you have a friend that plays golf? No. Do you want to find a friend that plays golf? I bet there's a bunch of handsome guys in the audience that would love to do something. Are you trying to, wait, you can't raffle off this stuff. It's very valuable. What? Oh, you give it to Gus. No, it's okay to give it to Gus. Anyone else I'd say no to. Okay. For you, Gus, yes. Okay. We have time. We literally were keeping on schedule. We've got a hot fudge sundae bar waiting. I did not eat any dinner. I hope you guys enjoyed the food. I have not eaten all night. Okay. And I'm actually very hungry. So hopefully Mary has a plate for me, Mary. Do you have a plate for me? No. Okay. No. Okay. It's not looking good for me right now. Okay, I'm going to be eating a lot of hot fudge sundae. We have room for one more question for Burt. He also has not eaten, and he's just drank Diet Coke all night, so he's also been very good. But one last question. Okay, I have very bad vision, but that looks like Jack of the Zakim Bridge in Boston.
What is Burt's forecast for interest rates in the short term and long term?
Okay, so the question was about interest rates. You want to take that one? That was a hard one. That's easy, right?
I'm getting tired.
Oh, she's tired. Okay, real quickly. So the Fed's told you that it's going to keep interest rates extremely low for a long period of time. And that's defined at some time into 2014. I think it's going to be hard-pressed to do it. So I believe that interest rates are going to stay relatively low for a while. I would say through the bulk of 2012 and into 2013. I believe the middle part of 2013 there's going to be pressure. Because I do believe that this recovery is for real. It is sustainable. And I think you're going to see GDP growth of 2 to 3% or so. And that's going to translate into some upticks in inflation. Especially as we start to see payrolls, jobs, at about 200,000 per month, which is about where we've been. And so if we continue to get that, you'll see some wage inflation, which means raises, guys, which is good, right? But you're going to see some ticking of inflation. I think the Fed's going to be hard-pressed to be able to keep rates low into 2014, 15, and 16. That being said, I think it's going to be relatively low for a while. The market is going to sniff that out. So the market's going to be moving rates higher, regardless of the Fed does. It's going to be moving rates higher throughout, so you're going to see those tick up just a little bit because the market's going to be concerned a little bit more about inflation than the Fed. The Fed's really concerned about growth. So you mix all that together and answer it really quickly. I think interest rates are going to stay low for the foreseeable time. Call it 18 months to 24 months. At that point in time, that's when I think that you might start to see inflation come in and there'll be some pressure for the Fed to begin to do something and raise rates a little bit.
All right, and then to follow up to that, because really, the logical follow-up is, and what does that mean to our portfolios, right? So what we have is the market, like you say, typically anticipates a rise in interest rates anywhere from like 6 to 12 months out.
Yep. So
basically what we're telling clients is that you can anticipate in about a year that the market is going to start responding or really anticipating the rise of interest rates. So we have actually a slide in our PowerPoint in the office that shows when inflation is low, but interest rates are starting to go up, that your best bet is still equities, and maybe a little bit of commodities. And then when inflation is high and starting to rise higher, then commodities is probably the better bet, and it actually mentions moving a little bit to cash.
Right.
So what we're
But what you didn't mention there was what most people's portfolio is, which is bonds.
Well, we are very unhappy with bonds right now,
Unhappy.
right? Unhappy
Absolutely,
with bonds,
absolutely.
right? So pretty much what we're saying to clients is we're really begging them to get out of bonds as long as their risk tolerance can handle it, right? So we have Warren Buffett, we have Larry Fink, a couple months ago, almost conspiring in the same week to tell us to all get out of bonds. And we're basically talking to clients and trying to convince them that that is not a good place for them to be over the long term. If they are in fixed income, and you guys have been talking about this since the bottom of the market in '09, it's high yield and then floating rate in anticipation of some of this, right? And emerging market bonds, of
Yep.
course, right? So if you have to be in bonds, we would argue probably spread product and opportunistic fixed income, right? And equities in a low but rising interest rate environment, which is what we anticipate.
Yeah, because remember, we were in for 30 years, we've been in a declining interest rate environment. For 30 years. We just remember that bonds always go up, right? They never lose money.
Well, I think people have gotten complacent about
We
bonds.
have, right?
Yeah.
And I think we thought that bonds can't go down, and we're always going to get income from them.
And we're also laughing at our friends who are in the equity markets, right? So
Exactly.
for the last 5 to 10 years, fixed income holders are saying, ha ha ha, you guys got all this volatility, you got absolutely nowhere,
Absolutely.
right? Yeah.
But remember, from 1950 into 1970, for that 20-year period, we were where we are right now, and that was low interest rates and rates were beginning to move higher. For those 20 years, bonds returned 1.8%. Inflation was 3%, which means you lost 1% a year, essentially, after inflation. Stock market did pretty well. So at the end of the day, we're about to enter that, and I think that we've become complacent. So we, as the industry, us as a market, have gotten complacent on fixed income, and we're trying to stay a step ahead by having that conversation now, because we believe that this is the real change in how we're going to have to manage portfolios. Bonds aren't safe anymore. They're the most expensive things out there. They're more